what we're going to be looking at here are bond issue costs and how we'd account for them. Now, our example is going to be where this bond is going to be issued at a discount, and it's going to have issue costs with it here. So, for example, Corp A issued a $3 million 10% bond here. It would be a 10-year bond on 1/1/20x1 at 97. What that means, it's 97% here of the par face value. That's what they're going to receive for this bond that they issued. So, and then there's interest payable semi-annually here on 1/1 and 7/1. And legal and other costs incurred are going to be $50,000. So that's what we're going to be looking at here. Looking at this bond here that was issued at a discount here, along with those legal costs here of $50,000. Now, Corp A uses the effective interest method here for amortizing a bond premium or discount, and any deferred charges on the bond, that would be their issue costs here, and those are that $50,000 we look at here. Now, issue costs are usually the legal commission here, fees involved here when you issue a bond here. So what we're going to do is we're going to go down here and we're going to look first at the entries here, and then we're going to track back and look through our how we would make our calculations here using this effective interest method. So going down here, and what I have it laid out here. We've got the assets shown over here, liabilities over here for this bond being issued here, and then on our income statement I'm showing some interest expenses here and issue expenses here. So we're going to go through these here, and we're not going to do the calculations until later here, but let's just go and look at how we lay this out here. So we've got these bonds payable, that $3 million worth of bonds that they issued here. This is our liability here on our balance sheet. We credit that here for $3 million, and then we have to set up this discount here on bonds payable. Again, on our balance sheet it's a contra account to our bonds payable, and we're going to calculate that here to be $90,000. So let's just go up and look at that here. So we've got the bonds payable here at $3 million. That's their maturity value here, and how we calculated a discount here is simply 97% here of the $3 million equals $2,910,000. So just subtracting our $2,910,000 from our $3 million here, we're going to come up with this discount here of $90,000. So that's easy enough to calculate. Now what we're really going to, so what we would do is we debit our discounts payable here for $90,000. Now the question is here, those are our liabilities here on this bond issue, but how would we record the assets here, the cash that was received when we issued these bonds or sold these bonds, and also this bond issue cost here? So let's just go up here and look at it real quickly on our calculation. So what we received here is $2,910,000 for the bonds, but we have to deal with this $50,000 worth of issue costs. What they do here is they divide up on our asset side here, deduct from the cash received. Normally, if we had no issue costs, we would have received $2,910,000 with these bonds issued at a discount. But we have the issue costs here, so what we do is we reduce our cash account here by the amount of those issue costs. So what we have is we've got, as far as an asset here, we're going to have, okay, let's just look at our arithmetic up here. $2,910,000 less $50,000 issue costs. Our cash amount here is going to be $2,860,000. So what we've done here is we've taken the okay, then $2,910,000 is divided here with the cash here of $2,860,000 debited here, and then we also debit bond issue costs here. That's what they call a deferred charge, and it's really a long-term asset here. So we got debit that here for $50,000. So our $2,910,000 is comprised here of the $2,860,000 here, the cash that we received. We actually received $209,000, but we have to divide it up here between. We have to allocate to the bond issue cost here that deferred charge here of $50,000 that we calculated here. Again, these bond issue costs here, those are a long-term asset. They're a deferred charge. And this is the way we do it here per GAAP here. We set up this asset account here for the bond issue cost. Now, I don't want to confuse things here, but with FASB, instead of putting them up here as an asset account, these bond issue costs would become would be a discount. It would be moved over here to a liability on the liability side of the equation, and they'd be a deduction here, or a contra account here to the bonds payable. So they just move over here. But in either case, they're going to become a charge here as an interest expense, or issue expense here for the bonds here we're going to amortize on our income statement, and an interest expense here for the bond itself here. We're going to have to amortize that. So, okay, we've set up at 1/1 here. We have 2,860,000 here for our cash account, bonds payable here 3 million, and then our discount to bonds payable here 90,000, contra account here to bonds payable again at 1/1, and then we have our bond issue costs here of debit that here for $50,000. Now, come along our payment dates here, and just looking at 7/1 here, and we're going to have a interest payment on this bond. All it is we can go through the calculations here, but it's $3 million every 6 months here for a half a year times 10% gives us $150,000. So we credit our cash account here for $150,000, and then we have to deal with the discount to our bonds payable. We have to amortize that, and we also have to amortize this bond issue cost here. So on 7/1, and we'll go through those amortization schedules here, but first just showing here on 7/1 we have this discount. This is the effective interest rate method. We got 26.52 here, and then let's just say what we would do is interest expense on the bond because it's issued at a discount here. We'd add the 150,000 plus the 2,652, and those are our credits here on our balance sheet, and then on our income statement we debit that here for $152,652 here. Just simply the discounted amount here plus the cash payment equals our interest expense here. Now, we have to deal with the bond issue cost here, and we're going to amortize that using the effective interest rate method here. So what we have to do is we've got these 20 payments here that we're going to 10 years twice or semi-annually. We're going to have 20 payments here, so we're going to have to amortize these bond issue costs over 20 payments, and also our discount to bonds payable over 20 payments here. So we're going to go through the calculations here, but our bond issue costs, effective interest rate method, we'd have $1,490 here, reduce our bond issue costs on our assets on our balance sheet, and then we go and recognize it on our income statement here, debit that for $1,490. Okay, I'm just showing 1 year here, the first year here, how we'd record it, but we would set up our amortization schedule here over 20 periods and recognize our interest expense and our issue costs here. And because we'll just go back here to our interest expense. You can see a cash payment was only was $150,000, but because we issued at a discount, our interest expense is going to be greater here, $152,000. It includes this. It's increased here by the amount of this discount here to our bonds payable here. Okay, so just at the end of the year, the same thing goes on here, but because we're going to only pay the payments out here at the beginning of the next year. They're on 7/1 and 1/1. We have to set up this interest payable. That's that interest payment here of $150,000, semi-annual interest payment here $150,000, and then we also have our discount to bonds payable here $27.91. So the total amount here will go to our interest expense $152,791 here. Credits balance with our debits, and then our issue expense. That's simply that amortization of the bond issue cost here. That's a deferred charge, as they call it. We'd credit that here for $1,566, and then issue expense here $1,566. So what we want to take away from here is when we're dealing with these bond issue costs here, we have to split up what we receive in our cash payment, what we would receive on this bond. We have to reduce it here by the amount of these bond issue costs. But in total here, our total assets or long-term assets equal the cash payment here and the bond issue cost that we talked about. And then over on our income statement for each period here, we just recognize our interest expense here on this bond, and then we also have to recognize the issue expense on the bond, and I've used the effective interest rate method here for amortizing it, only because it's a little bit more complicated. Had these moving over here to our bond issue costs, we could have used the straight line method for amortizing it as well, simply taking a $50,000 over 20 periods, and whatever we get here, then we would amortize it out. But I want to get into the complexities of using this effective interest method here. So let's go up and look at how we'd there's two things we have to determine here: the bond amortizing of our bond issue cost here, and amortizing of our discount on our bonds payable here. We have to determine both of those, and we're going to be using the effective interest rate method. So let's go up here and first look at the effective interest here on our bond issue cost, the issue cost here, how we'd amortize that. So we have to set up this amortization schedule. So what we would do here, we have our carrying amount here, and that was that cash amount that we debited our cash account here for. That was the 2910 of the total amount here less the issue cost of $50,000. So we start up with $2,860,000 here, and we're going to amortize it up here to $2,910,000. And what we have to do here, using this effective, we have to come up with our effective interest rate for each period here. Since they're semi-annual, we have to come up with the effective interest rate for that. So let's just go down and look at how I'm using the Excel function here, but you could use a financial calculator or what have you. So Excel function is that yield function here, and it's a 10-year bond. So I'm just putting in here 1/1/2010 it's issued. That's the settlement date here. That's the issue date here. And then it matures here 10 years later, and 1/1/2020, 10 years later. And then our interest rate, well, it was given here at 10% face value on that bond. And then what we have to put in here, this is a key point here, is the purchase price here and the redemption here. Now, this has really not, this is only to do with the calculations here. So let's go up here and, well, let's just do this first here for our yield. Remember, we started out here with our balance, the beginning balance here at $2,860,000. We divide that here by $2,910,000 here that we talked about before here, and we come up with this ratio here of 0.98282, and that is what we need when we're using our Excel function here or our financial calculators. We just can't put in the actual purchase price and the actual redemption. We have to put it in percentages in terms of 100. So once we put all those numbers in here, and when we're using this for our Excel function here, remember this 98 that transfers over here, or correlates here as 98.282. So we're taking 100% of that here. And then our redemption, that's at 100 here, twice semi-annually. Plug it in, and you're going to come up with an effective yield or interest rate here of 10.2790 here. Now, that for our semi-annual rate, it's just divide that here by 2, and you're going to get a 5.1395. So going up to our amortization schedule here, two things we have to deal with. We have to determine our discount here that has to be amortized, or the discount, our amount of amortization here for the discount, and we know our effective interest rate here. And I'm only using this for calculation here. I've got some cash paid here, semi-annual cash payments. This is not actually a cash payment here. This is only used to determine the amount of amortization here of our issue costs here. So what that correlates here is that $2,910,000 here that we would have normally received on the discount of that bond here, $2,910,000 times 10% here, or for a half a year here, and that equals $145,000. And the reason I use that here is for determining our amortization amount here. So our carrying amount, $2,860,000 here times the effective interest rate, and we're going to get an interest expense here of $146,990. Again, this is only for calculation. This is not an actual interest expense, but we would compare that to the cash payment. Again, this is only for calculations, $145,500. So we're going to get an amount amortizing of our discount here of $1,490 here. So to determine our new carrying amount here, all we do is add that here to our $2,860,000. We come up with $2,861,490. So we continue on this process here until we amortize it up here to $2,910,000, and that's going to take 20 periods here, or 10 years, twice per year here, 20 periods. So what we've done here is, this is how I've calculated the issue expense that we recognize here on our income statement each period here. This interest expense here and this semi-annual cash payment here is only for calculation purposes here, but this is our interest expense that we would recognize each period here. So that takes care of how we'd amortize our effective interest here for the issue cost here that we're looking at. Again, we had to calculate using our financial calculator. In this case, I used the Excel function here to determine what that effective interest rate was here in order that we were to amortize this carrying amount here from $2,860,000 up to $2,910,000. Okay, so now let's go down here and look at our effective interest here on the bond, the discount itself that's amortized here. So now this is really the second part here. So remember, we amortized that issue cost up to this amount here, $2,910,000. So what we do here is, this is where our starting point here for our bond discount amortization. Really, it's that $3 million here times 97% here, so $2,910,000. But remember, we amortize our issue cost up to this point here. So what we have to do here is we have to go in and we have to do our financial calculator here. Again, we have a settlement here. I'm using again this Excel yield function here. Settlement date, that's the purchase date here, or issue of the bond here, 2010. 10 years maturity here, 10 years later in 2020, again 10%. Interest rate, the face amount here of the bond, and then to determine our ratio here, all we do is we take that $2,910,000 here, that's the discounted amount here, divided by the maturity value of $3 million, we get that 97 here, and that's 0.97. So we take that and times our 100% here, we get 97 here is the purchase price here, and then the redemption here, that amount here is 100 twice semi-annually. We're going to come up with an effective interest rate here of 10.49154 here. So semi-annually, you divide that amount by 2, you're going to get up to 5.2458%. So now we can go up to and set up our amortization schedule. Again, here's where we start out with our carrying amount here of $2,910,000 here, and we've got our effective interest rate here of 5.2458%. Take that times that amount here, $2,910,000, and we're going to get an interest expense here for this first period of $152,652. Now, to determine our amortized discount here, remember this is where we actually made that cash payment semi-annually. That was that it would be $150,000. That's the interest that's paid here semi-annually on the bond. That was the $3 million here times 10% for 6/12 or half a year here, 6 months at a 12. You're going to come up with that interest payment here of $150,000. So now for our amortization amount, same as we did for that other schedule, but these are actually payments that we're going to make here, and this is also the interest expense that we're going to recognize here in the bond. So we had our interest expense $152,652, cash payment $150,000. So our discount here was the difference here, $2,652. So adding that to a beginning carrying amount here of $2,910,000 gives us a new carrying amount here of $2,912,652. Taking that times our effective interest rate, we're going to come up with our interest expense for the next period here, $152,791, and then our cash payment for the second period, $150,000. So our new amortized amount here is $2,791. Add that to a beginning carrying amount here, and we get our new carrying amount here of $2,915,443. So what we would do is just continue on here for periods here, starting with the first period here up through our 20th period. So what we're done is we're going to amortize here from $2,910,000 up to $3 million here. So what we're doing here, again, this was for our interest expense here that we recognize here on our income statement, and this was that cash payment here on the bond. So what we've done is we've actually set up two amortization schedules here. One for our bond issue cost that we amortized here, and then one for our interest expense here on the bond itself. All right, so that takes care of our two methods. I know it's a bit lengthy here, but this is how you would handle those bond issue costs when you're dealing with, and we looked at it from a discounted bond here, but if you had a premium, you would be doing very similar here, only you would be working with a premium amount. All right, so that takes care of our bond issue costs here with our discount here and our interest expense here on the bond.